My guest today is Dan Tamkin. He's a founder of Resurgent Capital Partners. Over 6 years, they've bought 5 businesses and are the majority equity holders in their company. Their 5 businesses sum to over 60 million in revenue with 200 employees and greater than 8 million in EBITDA. Thanks a lot for coming to the Holdco Builders show, Dan.
No, thanks for having me. Appreciate it.
You look for opportunities where you can add value via business improvement and growth. We are getting into all that, but first, can you share us your background and what inspired you to become an entrepreneur in the first place?
Sure. I think the headline there is as I learned more about myself, I steered into what I thought I was good at as opposed to trying to make myself good at things I wasn't good at. So the details underneath that are, I started my career by turning around a broken software company, which I actually now own again. I turned around, sold it, now I own it again, called Unified Dispatch. And then from there, during the time I owned Unified Dispatch, I thought I was not very good at sales. So I hired a sales guy, but the company wasn't making enough money at that point to really pay me anything as a sales guy. So I actually went and got a job in venture capital, became associated at a venture firm. And I think, especially for younger people listening, like there's hot jobs when you're getting out of school. Like I wanted the investment banking job when I got out of school, which I didn't get. And then, at that time, venture capital was hot. So I wanted the venture job, which I did get. And I spent 2 years in venture and realized having small stakes in companies that either go to the moon or implode or explode did not fit my personality. It was not something I liked. I like having control. I like being involved in the operations. And so, that was my first thing to say, hey, I like being that type of investor isn't what I want. So then from there, once I went back to Unified, grew it some more, sold it, and then became CTO of a couple $1 billion company. It was a transportation company called Transdev. It's actually a $10 billion French company. The US side was $2 billion. Built a 75-person technology unit. Actually ran a $100 million business unit for them for a period of time. This was all over 4 years. At the same time, my kids were born then. So it was kind of like a nice time to hide out in a big company. My daughter was born a month after we sold Unified Dispatch. So that was a nice present for my wife and I after. And then from there, got really sick of big company life. Predictably, like a lot of people, didn't really see it as a fit for me. And wanted to go back to the route I did at UDI, which was turn around broken software companies, venture-backed software companies specifically. So I went and did 3 of those deals in partnership with another group. And what I realized there was it was kind of like hero stuff. It was great. It was a lot of fun. We were making big decisions. All 3 companies, I got break even in 30 days. It was neat. It was the most work I've ever done in my life and the least amount of money I made for it. So then I reconnected with a guy I had met about, I think at that point, 10 years earlier, actually at the venture firm, Bryce Winkle, and kind of explained to him what I was doing. And he's like, you could apply those same skills to private equity. And instead of like trying to fix companies with 7 things wrong, maybe find companies that have like 1 or 2 things wrong that you can fix. I'm like, oh, that sounds a little easier. And I had been talking to Bryce for years about, Bryce and others about how to get into private equity and kind of similar to my story, how I didn't get into banking. I could not break into private equity. I mean, if you're not on, as you probably well know, if you're not on that track, that finance track, it's almost impossible to get in. So I think my most popular tweet ever was the one I said, hey, I just started my own PE firm. Well, that was the only way I was getting in. I was not going to end up getting a VP job at Gores, which was one of the larger PE firms here in LA at the time, where Bryce came from, or somewhere else. And if I came in anywhere, it would have been on the operating side, which is it's very hard to get from the operating side to the investing side. So had to knock down the door on my own by creating my own.
Okay. What about this period? Obviously, learned so much. We can't cover it all, but what were your strengths doing it all? I mean, growing those SaaS businesses from losing money to break even in 30 days. What was the typical case? Was it like a repeat scenario which you did again and again, or what did you do there?
No, it was kind of like a different puzzle every time, which is what made it really cool. Is you go in and look at a company and you try to figure out what's wrong. How can I make this thing profitable? Um, Sometimes there might be two product lines, and one product line is extremely profitable, and the other is actually sucking all the resources out of the business. I think that would be the limos.com example. In the case of Blue Cod, where we did turnaround there, it would be the really poor technology decisions and just frankly making some simple decisions and being out and beating the path to get the customers happier and just knocking down issues every day and being extremely focused. And then in the case of a manufacturing turnaround, I did actually, it was, kind of simplify. It was actually the same thing. You're looking at two product lines. One product line made money, the other spent it. You kill the other product line. So every time it was kind of something different. I mean, unfortunately, every time, right, it always involves some kind of cost cutting, which cost cutting in most of these businesses involves people. And obviously that's like 0.0 fun. And then there's also other decisions around, vendors and customers and other things that you make as a way of realizing that you're always on borrowed time if you're not making money. And so I was trying to give the companies back time. And then once they were profitable, the idea was, what are we going to do with these things?
And what was the journey? I mean, if you're into software companies, I mean, turning them from losing money to break even and eventually profitable, the multiples are probably the best they can be, especially if it's like a B2B. So when did you decide that let's partner up with Price and doing it on like together?
Yeah, I think so of the 5 deals we've done, right, two are what I'd call regular operating companies, and between the freight brokerage and the tanning salons, and then the other three are SaaS deals. I don't think we didn't necessarily set out to do SaaS businesses. When you're starting your firm, a friend of mine who started his firm and has now gone on to raise a bunch of funds said, like, these horrible deals are the only deals we can do, so that's why we do them. And I don't think of our deals as horrible, but I think it's a good analogy to say it's like when you're starting out, you like, what are you're making the best of the opportunities you find, right? A large fund would not own the 5 businesses we owned. They would have gone for larger companies that were more established, right? So these were the opportunities that were available to us, and we've made the best that we can with them. And frankly, we've been pretty exciting about them, and they've been a lot of fun, and obviously there's been some good success. So in no way are we sad about it, but I think I think if you're starting as an independent sponsor, which is generally what you would call Resurgent Capital Partners as an independent sponsor, we're different because of our high equity percentage in the companies. That's probably the one place we differ from most people in that world. You have to start somewhere, right? And for us, these were the deals that were apparent. I think the common link between all 5, going a little bit back to your question, is that I had, was there something we could do from the technology side to improve the businesses? So even in the tanning salons, there was things we did from a technical perspective that improved the performance of the business.
What was your thought process, or how it is now when it comes to being extremely focused on one opportunity versus having portfolio of 5 businesses in different industries?
Yeah, I think that's going back to steering into who I am. I get really bored if I focus on one thing for kind of like over 3 years. So my dream was always to have, after I realized that about myself, to have multiple businesses, because I thought it would keep me curious and interested, and it has. So that's worked out. Obviously, I think if there's somebody on Twitter that always asks, would you rather have, what is it, 4 $2 million EBITDA business or one $8 million EBITDA business? I think it's an interesting question. Obviously, there's a lot of other things to it, but for me, putting money aside, and we all know how multiples work, the curiosity and interest and excitement in my own life and business, work life, it all, personal life, all kind of blends together. I don't know, there's really a fine line. It's it's exciting to me to have different things to be thinking about.
Partnership with Bruce, how much can you share? Uh, what were the discussions about? Because I mean, the partnership is probably the most important thing when starting such a venture. You said you know each other 10 years. His background is doing deals. Your background is more like operating businesses. So it's a great uh, combination of a team. So what were the conversations, and what was the last conversation you had? Like, okay, let's go and do it. Let's actually start acquiring businesses.
Yeah, so I think in it's over the 10 years I kind of knew him before we worked together. We were not really in conversation. I would when I
Mm-hmm.
meet interesting people, I kind of note who they are, and I keep in touch with them periodically. And when I mean periodically, it might be like every year or so. And in Bryce's case, it was probably even less frequent than that. So when I wanted to start Resurgent, because of his PE background, he was someone I was interested in talking to. It just so happened that he was trying to start his own firm, and he had a partnership experience that didn't work, just as I had kind of a partnership experience before that didn't work. Um, so we kind of came together at a time that just um, kind of just seemed to make sense. I was already doing Resurgent. I was just by myself. I had some deal flow. I had some things moving. So I think that gave him something to grab onto. Everything we do is 50-50. That's one basis, but for us, that's worked really, really well. So, we're both really co-founders of Resurgent because last time we checked 100% of zero was zero. And could not have, this is not something I don't think I could have done without him. And I don't think he could have done it without me. So I think we're very fortunate to have each other. But partnership is interesting. He bought a house, and I had to sign a bunch of paperwork, which I've never in my life had to sign paperwork for somebody I'm not related to. But it just tells you how intertwined we are. Um, but there's so much trust built up that it's almost like he's family. It's a very it's a very odd thing, right? I mean, somebody that you're sharing so much with, and I'd probably talk to him 5-6 times a day. So it's actually been really wonderful, and kind of back to like steering into who you are. Like, it's a lot more fun to do this with him, and I'd say with him specifically, um, than anybody else, right? I mean, it's great and it's fun to do it with somebody else, and I don't think it'd be nearly as fun for me if I did this by myself. And as much as I care about money, like money's great and all, I'm really driven by, like, am I interested and excited? Because I think money will just kind of follow everything else. If I'm interested and excited, I think it'll work out for me. If I'm not, it won't.
And how was it in the early days when you started? Did you put together like a pitch and went to approach investors, or it was just you two and you just started looking at different deals, or how was this, and how was the timeline of it all in the first maybe 18 months?
Yeah, so we had a really interesting start. I was on the board of a company that got sold, and the the company was having problems, and so I got a consulting contract to kind of come in and fix that company, which Bryce helped me negotiate, and probably helped me negotiate a bigger number than I would have asked for on my own. So, speaking again about the value of a partner, um, we used the funds from that to go out and basically build our firm. And then it took us about, I think, 18 months, maybe 24 months to get Manning's done, which was our first deal. I think that's about the timeline. So there are probably 3 months at the beginning where we had nothing coming in, which is guys that had prior success. That it's not like we were going to go bankrupt, but that doesn't feel good, right? It doesn't feel good watching your bank account dwindle when you both have families and all that. The consulting contract allowed us to spend money on firm building, and then that led to our kind of our first deal. And then pretty quickly after, I think we closed another deal, and then we were kind of off and moving. Generally, for independent sponsors, closing one deal is not enough. cash flow to to make it work when you're two guys that are used to higher compensation, right?
I think the first deal is so important, and a lot of people obviously struggling with this. Can you share the structure or more details about it?
Sure. It was actually it was kind of interesting. So it started with it was a asset light freight brokerage in Omaha called Manning's Truck Brokerage. Nothing to do with Peyton Manning, by the way. And we saw it because of my transportation background. We got interested in it. It was listed as a B2B brokerage, and it was a north of $2 million EBITDA deal being represented by a firm that usually doesn't represent deals that big. So we generally think that's an opportunity because it's a misfit from the perspective of you got the wrong, probably not the right firm repping it, and they called it a B2B transportation service, as I mentioned, when it was a freight brokerage. Well, what does a B2B transportation service sell for? I don't know, 2.5, 3 times. What does a freight brokerage sell for? 7 times. So we had an embedded option, from the beginning, that the deal was mismarketed, and I think that's, especially if you're an independent sponsor, really important to understand is like where is your edge in the deal process, because just winning an auction doesn't usually yield any value, unless you're going to grow the heck out of the thing. You got to build some value on the buy. Um, and so we went and visited the company. There was one guy in front of us. He fell down. Uh, Owner signed our LOI. Liked the owner. Good dude. Still keep in touch with them once in a while. And then what happened is the business performed. So we had a fully levered deal set up. So Bryce and I actually would have been like the other four companies, the owners basically. But the business's performance started to suffer. And just by chance, where Resurgent's office was in the same office building as another, like they're kind of an independent sponsor, but they're more of a family office because they have a bigger capital base. And they were going down the elevator one day and talking about deals. And I just said, hey, like, do you invest in real estate or do you invest in business, like businesses? And I'm like, oh, I have this freight brokerage I'm looking at, and blah blah blah. We had to recut the deal because of the financial performance. All the debt went out. We ended up doing an all equity deal. And we used their equity as well as equity from Bryce and I, but they were the lion's share of it. They were awesome partners. It was great working with them. We brought in a CEO who's someone I had known for a few years, and it ended up working out well. But I think the lesson learned there is like sometimes you're in the middle of a deal process, things don't go as you planned, and uh, you can recut it and figure out if assuming you think it's still savable, and that was that was the opportunity for us. I think most important for us was our first deal was a stepping stone to future deals. It was not about like making $1 billion on our first deal. Like we knew we wanted to do multiple deals. It was more important than anything to get started. When you're on a phone with like a capital provider or somebody and you're like, I've done 0 deals, the two of us together have done 0 deals, it's really tough. One, it's like, okay, you've done something. Two, oh, okay. And then, three and above, it's like your credibility is no longer really questioned. Um, so I think if you want to have a long view in the world, and Bryce and I always had at least a decade view of things. It's like we kind of planned in decades of like, we're going to work together for this decade and we're, 7 years through it. That's a big competitive advantage versus if I thought like, oh, how much can I make on Mannings? That probably would have led us to probably not do the deal. So I think important to think in a if you're building a firm, important to think in a long time frame.
So this first deal gave you credibility in terms of lenders, future sellers who you're going to reach out. What did it do with your self-belief?
I don't think it changed anything there. I mean, it was. Um, I mean, of all the, it actually. I was about to say of the five, has it been the most? Was it the most challenging? Maybe it's tied with one other deal for that, but it had a lot of challenges in it. But because of my prior background, I knew I could get through the challenges. Um, I kind of have this. I have this saying in my mind, which is not great. I'm not sure I should say it out loud, but it's like when I was doing one of the turnarounds at the prior firm. In my mind, I used to say like, "I'll drag your dead body to the finish line." Basically, like I will do whatever it takes. Like I'm not going to be. I'm my own mental whatever. Like I'm just going to be strong enough to get through it, and that probably comes from when I came out of school. I was work, actually my first job was in a medical device company that was distressed. I've been around messed up situations most of my career, so I think I've always, and then I had the turnaround I did with Unified the first time. So I've always been in situations that were like high tension, high stress. Things got to get done 5 minutes ago. Um, so I think I'm 20 years into my career. It's not like if it's your first time encountering it, it might feel like something. For me at this point. It's just like that's Monday. It's not a big deal.
And the first deal, how was the post acquisitions next 30, 60, 90 days? How did it go? What did you have to do? Did you have to change anything? What was the
Yeah,
plan and how did it go?
I think sometimes when you talk to people that have done a lot of deals, it's really awesome. Like they'll say a phrase and it sums things up well. So the guys we worked with for the equity, um, his statement was, "You never know what you bought until you bought it." And I think that's like in one moment that's a really uncomfortable statement because it's like, well, didn't you do any due diligence? Didn't you do this? Da, 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 da. It's like you can do all the diligence in the world, but you don't really know what you own until you own it. And that is, I think people that have done enough deals really know that's probably the truth. Um, so we bought the business, and the main goal was to automate the back office to drop out some cost, take that savings and invest in building a sales force and grow the business. The business didn't really have much of a sales force, and that's some version of that is almost always our investment thesis. We can get a return by some kind of automation or cost thing, and then the super normal return is by some kind of growth in revenues. Um, when we got in there, it was about we got in there. The people were not ready. It was not a platform that was growable. And I mean, more on the people side. So we probably replaced in the 6 months. I think the CEO replaced 70% of the people. Yeah, I think that's about it. Just to get to a point where we had people that were growable. The prior CEO the prior owner had gotten things done by force of will, which is, to my earlier point, great, but may not be the most easiest way to grow a company. So we really had to kind of, when I say platform, I'm not necessarily saying the technology. There was some of that, but it was really the people. There was people and process also that were missing to create growth. So that was an unexpected challenge. Um, the company hauled dairy, butter, meat, and seed around the Midwest. We were hit 90 days in with like epic flooding, and we were really tied into the soybean crop. And we had 2 seasons when the seeds went in and then the soybean went out. Um, and so what happened was those seasons were cut short, and we had some customer concentrate. The business was tied to that because of its one. It did have a dominant customer. So that created a lot of challenge for us, but thankfully, because we dropped out the back office costs, we still had the resources to continue investing in the growth, and we didn't have any debt, so we can keep pushing through. And ultimately, it worked out. We ended up getting, a pretty great acquisition offer that we took, actually only a couple of years later.
Maybe I missed this part of this truck brokerage firm when it comes to CEO. Did you bring a new one?
Yeah, yeah. So it was a guy I had, because I had experience in the transportation industry. Mostly of my experience was in moving people, not goods. But I had looked at a business that was moving goods. Had met a guy, and I called him to ask him what he thought of the business, and he kind of volunteered that he'd be interested in moving from San Diego to Omaha, which is not not something that's common. I think he's still in Omaha and enjoying it, so I think it's worked out well for him and his family. So he was interested in being CEO, and he was a very credible guy to back, and it worked out.
And did it? I'm just asking because I'm having maybe a similar deal in place. How much you can share when it comes to incentivizing this CEO? I mean, here is. Did you give him an equity or how was it?
Yeah, I mean, I had a very early boss that was like, if you want somebody to do well, like share. So I
Mhm.
think most PE CEOs are what, like 3%. Now usually those are on larger deals anyways, but we were closer to 7 to 10. We gave him a lot. Yeah. And now he was moving also from Omaha to,
Oh.
or from San Diego to Omaha. So part of it was also you had to make sure the deal was sweet enough for him to go. Um, but there was enough upside incentive to share if it worked out.
Was it more like a case where just hire a great person and let them do the job and just make sure you're not on the way, or it was more like a partnership that you did everything together with Bryce, you and the new CEO?
I think we worked on a plan with him, and he implemented it pretty well. I think there were generally, kind of going back to the split in our portfolios. There's the SaaS companies, and then there's the tanning salons and the freight brokerage. Um, those are the tanning salons and the freight brokerage more mature businesses, um, and they're able to bring in, that they have higher level executive leadership in them that you're helping course correct with. Maybe there's a point project we're doing something on, where maybe my technical expertise is useful, but we're not trying to run the company through them, right? That's their job, and we don't want to kind of get in their way. And we're a two partners, and we have an associate at our firm. So there's three of us. Currently there's four active portfolio companies. There's not really a lot of like, most of my time is spent on the operations, probably 75%, maybe more sometimes. And the other two are mostly focused on deals. Like we can't, uh, we can of course hire, but it's hard for us to get much deeper into the details, right? We don't really, especially at that time as Bryce and I, if we were running Mannings while trying to do another deal, like it's pretty tough, right? So you kind of got to let the person do their job. It's also what they prefer, by the way. They don't want, if you hire competent executives, they don't want you there all the time and in the way they've been successful in their life doing it a certain way, and you kind of got to work with them on it.
And when it comes to timeline, what's next? What was the next move for you and Price?
I think we bought my old company back, Unified Dispatch. That was kind of a fortunate matter where we were paid to. It was a carve out that we were kind of paid to take, or it's basically free, and we've been able to triple the company's revenue and grow it quite well. So it was nice. That worked out pretty well. And for me, it's great because even though it's the smallest company we have, um, it's a lot of people I work, that I've worked with for years, and so I get to work with all these great people that I really enjoy. So I get a lot of, and even I've known some of these customers for almost 20 years. Like, so even the customers are people that I would consider, friends and all that. So it's kind of it's fun business to run, and it's fun, great employees, great customers, and great business partners too. We have some partners in that business that are awesome. We worked with for years. So that I get a lot of joy out of spending time with that business, frankly.
Unified Dispatch, did you start and sold it, or did you bought and sold it?
So I was the CFO of the original company. We had raised 4 million in venture. It had an idea of basically providing outsourced call center services, specifically the taxi industry. That didn't work. I bought the business with some investors for a small amount of money, restarted it from scratch and made it a technology company, and then grew it and sold it to Transdev over the course of 5 years, including that stint in between when I was in venture capital. So kind of an unusual story, but yeah, it worked out.
You've you've shared the line like the three elements of a great deal. Uh, this
Yeah.
number one, the deal. Number two, purchase price financing. Number three, value creation strategy, and this equals success deal. When did you learn this? That this should be the formula I should follow every time, and maybe you can share more about each each step, so called,
Yeah,
each element.
I think this is specific. uh, It's probably a formula you can use for any deal, but I think it's really specific to independent sponsors. In the independent sponsor market, a lot of times, if you're doing a bigger deal, you're going to a fund, they're already getting a carry from their investors, and then we're asking for a carry. So you got this thing called the double carry problem. Well, if they're getting carry, we're getting carry. What value are we bringing? Like just finding a deal and winning an auction isn't really bringing value. So we have to get someone else to like us liking the deal. It's one of the smaller ones that Bryce and I just do with our equity and some debt, which is we've done kind of three of them that way. That's one thing. If we need outside capital, we have to convince them, and then we have usually the double carry problem. And so for them, it's like, okay, is this company or this acquisition is this something we're willing to invest in? Does it meet these characteristics, customer concentration, supplier concentration, which is just kind of the normal things you tick the boxes on. And then the second category is how are we going to finance it? I've always like, for instance, I love permanent equity strategy about equity, equitizing the company fully because, frankly, the cost of mezz debt nowadays is so high. I mean, that's like the IRR of most PE funds. That, anyways. So I don't know why people wouldn't have that, but that's just not something people wouldn't want that yield for themselves. Certainly, I would love it. So sometimes there's alternative strategies you might pursue on financing that might make the deal cheaper, and some of that may be deal structure. And I think increasingly the third piece, the value creation, given that when I started 7-8 years ago, I'd say valuations were a turn or a turn and a half lower. Now they're a turn and a half higher. All of that comes out of the equity side, really. And in fact, as debt gets more conservative, it probably looks like 2 turns of equity. Well, if you're an independent sponsor, the 2 turns of equity comes out of your hide, comes out of how much money you make. And so you really have to have the value creation plan nailed. You have to have a way that you're going to increase the EBITDA of the target. And that's just, and I will say beyond the valuations going up, I'd say there's also some professionalization in terms of the way businesses are sold at the lower middle market, which is generally defined as like, let's say 2 to 10 EBITDA, which is where we hunt. So from my perspective, those are the 3 things, and I think recently you got to really lean into the value creation strategy. And we've always had the same model, which has been the first level 1 is some kind of cost cutting or something we can do to get to an acceptable return. Basically, if we can't grow revenue, what can we do on cost? And then level 2 is selling, same product to same product to same customers. Level 3 is selling, basically kind of like expansion in the customer base. Level 3 is selling, new products to same customers, and then level 4 is new products, new customers, right? And as you can, those are higher risk each point you go up there, but obviously if you nail it, higher return. But we're never trying to underwrite like getting into a brand new market with a brand new product. That's the most risk. So that kind of goes back to I think the value creation piece increasingly is really more important. And as independent sponsor, what are you bringing to the table? Because again, winning an auction usually will not get you a deal done at this point.
And do you prefer to grow those companies? You said fixing the expenses. What about an add-on acquisition? Have you done it? Have you considered it?
Yeah, no, we've done it, especially the tanning salons, because we buy in other salons. It's a great way to go. I think in SaaS it's difficult because of valuations. I don't think we're great believers that a dollar from a SaaS company should be valued different than a dollar from another business. The market says we're wrong on that, but I guess that's just the way we feel. Where in Manning's the beginning notion was to build out more of a platform and to buy in more freight brokerages. We just ended up getting gobbled by an even larger freight brokerage, and we've infilled with the tanning salons as well. So I actually think a great a great thesis right now for independent sponsors is buy and build. If you look at some of the most successful guys out there, like the LP first guys like Thomas, um, that's really what they're doing is buy and builds. And I think in an area, at a time of higher valuations, that's a way to bridge that gap.
And what about you and Price? Do you have a goal to buy the business, grow the business, sell the business, or you prefer to keep them for a long, long time?
Um, my personal view on this kind of stuff is the world of finance has way too much power on the world of business. Um,
Mm-hmm.
Entrepreneurs, CEOs, and really probably more the entrepreneur should be the one deciding what's happening with their business because they know best. So our businesses are capitalized each individually. There's no cross collateralization, so one doesn't owe another anything or pledge any debt or anything like that or equity. And the point of that is to just maximize what's best for that business. So if an exit's best, which was the case in Manning's, fine. Um, if owning it and continuing to own it is best, that's what we'll do. We'll always do what we think is in the best interest of the business. And kind of, I really believe by thinking about what's in the best interest of the business, we'll always do what's in the best interest of ourselves because ultimately we're the owners.
On your website, it says that you pretty much invest in two categories: special situations, orphan assets, and performing companies. Which one do you prefer, and which, considering the economy and the market, has there been more opportunities when it comes to special situations and orphan assets, or how has it been, and what do you prefer?
Yeah, that's a good question. I mean, so I'd say two fit into, the performing assets, and that would be the tanning salons, the freight brokers. And because we don't really believe in the revenue multiples, the SaaS companies fit in the special situations category. So one was a carve out, one was a partnership dispute, and one was, kind of owners that had owned it for 30 years and were in their 80s and wanted to retire and didn't want to run a formal process. So they were companies that were opportunities that came across because they had something kind of not right with them on the SaaS companies, and then our job, of course, is to fix that. I don't know that I necessarily have a preference for one model or the other. I think at four portfolio companies, it would be it's certainly less work for me to get a performing one, so I wouldn't mind one that isn't such a scratch and dent asset. Um, but but back to my earlier point, we'll kind of we're we're always looking for an asymmetric outcome, right? And so we'll kind of look for whatever bucket fits that opportunity. If we can find a way we can put in equity and have a large outcome possible, we're interested, and I kind of don't care which bucket it fits in.
And how has it been competition-wise when it comes to those deals, comparing those two, if you can?
Yeah, I mean, there's a lot more competition for the performing assets. There's more capital for performing assets. There's more of, I think, if you have less of an operational background, it's easier. So there's more people that are capable in those deals. So yeah, definitely a lot more competition on the performing side. You're in a weird world in the orphan assets and the turnarounds and kind of like deals with problems, I guess I would call them. Um, there's less people competing for it, but there's also less capital interested because it's risky. And some people, I think, forget when they're talking to investors that are not investing their own personal money, their first job is not to get fired, right? And so if their first job is not to get fired, taking crazy risk on this deal probably gets them in more trouble. Where if they take less risk on a deal where yes, the return's lower. Um, so there's more of an established capital base for the performing deals versus kind of the weird ones. So we have to push harder and work harder to find the capital for them. Again, the three we've done have the only equity's been Bryce and I, and we've used some debt. So it's worked out well for us. But certainly, as people look at like failing venture assets, I know even though I've done that in my career, and there's a lot of people now that are discovering that as a hot way to do business. I think you got to put some real equity into some of those to get the debt clear to get things cleaned up, then you got to figure out, is it actually going to be worth it at the end of the day? There's a little bit of a no man's land. I feel like when if you're working on a carry, there's a little bit of a no man's land on small deals, because if you grow a small deal, it's 20% of a small number is still a small number. And then there's Bryce and I, and we have an associate, right? So we tend to either want to own something ourselves smaller, or have a carry on something bigger, and try to avoid that kind of no man's land in between.
Did you learn it in a hard way of doing two small deals, or you were like, okay, let's stay away from this?
No, I think maybe we learned it a little bit after Manning's, but as I said, I looked at Manning's as getting going, and not necessarily about what money we would make on it. Um, I think it's just how our portfolio has evolved. Because again, I don't know many other independent sponsors that are in our situation. That usually they do larger deals. They have a much smaller percentage of. Um, it gives us kind of the freedom and flexibility to choose our next opportunities, and not have to be so, I guess, we do what lands on our plate type thing. Um, and so I think we've landed on that as the model that makes most sense, because we do put a lot of resources, even if it's a performing deal, we put a lot of resource and time into every deal. Um, we, it's easier for me to lose my money than someone else's money, right? So there's a lot of responsibility when you take somebody else's money, debt or equity.
Do you have like a rule, or I don't know how to say it in a better way, between you and Bruce, that you have to do X amount of deals in a year, or you just go with the flow pretty much? Once you find something good, you commit, and if not, we'll just keep waiting.
No, I mean, I think where Bryce and I are at this point is because of the portfolio's current situations, we don't have to do a deal. And because we don't have committed capital, we don't have to push money out. So we're really doing things we want to do. And again, kind of like back to interest and excitement in my own life, like that's important to me. Doing deals I want to do, not deals I feel like I have to do. Um, and so at this point, we kind of sit on pitches, and we're waiting for things are good. And as I mentioned, valuations had pushed up. I'd say pre COVID, we probably had two deals, one and a half deals under LOI at any time. Nowadays, we probably have a half deal under LOI on average at any time. So it's definitely slowed down post COVID. Part of it's the valuations. Part of it's the fact we have a portfolio. Um, and I think we're willing to sit on pitches a little bit more than we were in the early days.
When you look at the last 18 months, how has the best deals come to you? The ones you would actually consider moving forward? Have you been actively looking, building relationship with brokers, or people know and like and trust you? They reach out to you, or how has it been?
Yeah, I mean, we certainly we do a lot of banker, broker, M&A intermediary outreach. It's a big piece of what we do. Um, Always follow up on deals that we are interested in that we lost, but a lot of times those don't close. So it's good to follow up, because maybe it falls out, and now we get an opportunity at it again when we didn't have, when we thought it was gone. I'd always follow up on deals that you think you lost, because a lot of times they don't close. I think over the 18 months, valuations have started to soften a little bit. There's certainly more structure in the market. Maybe headline prices similar, but like structure's higher versus cash at close. Um, we've seen, our capital providers be a little more conservative than they were, which is pretty natural given the pullback in kind of consumer spending. I mean, those are probably the two biggest things. Maybe a little bit more professionalization. I feel like I'm seeing more investment banks repping. Maybe I call them brokers repping smaller deals. Maybe it feels like the lower middle market, and maybe not the last 18 months, but over the past like 5 years, has figured out a little bit better as sellers how to represent and put businesses out to market, which is good for the sellers of businesses.
You have a portfolio of 4 active companies, quite diversified portfolio. How do you find the best people to run those businesses?
Yeah, I think you have to really define what you're looking for in a person, and then find the person that actually is good at that. Um, don't expect people to be something they're not, or magically change. Most executives and people that have achieved have gotten somewhere in life because they're good at a few things. Um, Let them steer into the things they're good at. Do not ask them to do things outside of that. So most of the time, I'm meeting with somebody. That's what I'm thinking. I was like, what is this person good at? What do they like? Um, and how do I set them up for success? So like recently, we bought Sonnet. At some point, there will be a CEO. I'm currently filling the CEO chair, which is pretty normal for the distress stuff, or the orphan stuff we do for the beginning. I'm now starting to think about, okay, who's going to fill that seat, and what does that person look like? And it's taken me time to figure out what should that person look like. What skill sets. Like for instance, when we bought it, we thought it was more of a software company. It's probably more of a payments company. And so now we have to be figuring out, okay, we need really somebody from payments that's going to run this business, and then it sells to the government. So it's like, okay, well, and it's state and county government usually. So it's okay, someone familiar with state and county payments, right? Okay, so that's kind of the first thing. And then underneath it, what are our challenges? Well, we have a pretty solid technical team. Rebuilt the tech platform and all that. Don't really need someone that's very technical. Need someone who knows how to build a sales process. Okay, so you start kind of working down the list of like, what does this person need to be good at? It happens to all of us. We do this, but it's like I know a guy. Well, it's like, okay, yeah, I mean, you know this one person, and that's why you're fixated on them. I don't like that being the answer. I think for a lot of us in life, it is the answer. Um, but I prefer to have some kind of process where you actually go out and talk to other people, not just like some guy just not your buddy.
That's why I wanted to ask, how much do you rely on your network? Because you've been doing that for quite a long time compared when you would start today, or when you're actually looking for this specific CEO today. Do you rely on your network, or you just
Well, I will, and
start the
we'll
process from scratch?
certainly use it. And that gives the person an advantage, but I think you want to see other candidates. I guess like I start with trust with everybody. Like the default mode is trust. So if the point of a network is trust, um, yeah, it matters. But since I start with trust, I'm willing to work with other people. If I started with distrust, then yeah, my network would mean probably it would give you more of a leg up, just because I go, well, I know that, I quote unquote trust this person. I think a lot of people start with distrust, which is tough to, it's, if you do that, then you're really kind of, it's a limited set of people you're willing to work with, right?
You've posted a few months ago on Twitter. A lot of people think when you run a business, you tell everyone how it is and how it goes. Basically, you're a king. After 20 years of doing this, I want you to know that is not true. I work for my customers, my employees, and my partners. I find that an honor, not a burden. How hands-on you are on day to day when it comes to four companies, and why I'm asking is, we are getting into this as well, like how big you want to build this, because I think one moment you can't be so active with all of those businesses, otherwise you can't manage it all, because you have your family, you have 24 hours a day.
2 years ago at Unified Dispatch, we had an intern, um, and he started doing really well. He took over quality assurance for us. Um, we were riding in the elevator one day, and I said, "Are you still learning?" And he goes, and I said, "Look, like if you're not learning, because it's still mid-20s or whatever, I'm like late 20s, I think at that point. Like you need to leave if you're not learning." I said, "I'm not kicking you out. I love having you here. I'm super happy having you here, but you need to keep growing in your own career." Um, he moved into product management. He stayed a few more years. I left. He actually helped me at one of the businesses for a while, and then now he went back into product management, which was the right fit for him. Um, and I think he's now running a business unit. And so, as of the last text I have, and so for me, like that's a really gratifying story, is to see how much people have grown and how much people have progressed. So when I think about like I work for my customers and I work for my employees, and I work for Bryce, and I work for Ali, and everybody else, in my family. I don't. It's not a burden. It's just like kind of the fact of the matter, and I think it keeps you in some way humble about the fact that we're all just kind of animals with clothes on. Um, it also it also is like if you can help improve other people's lives, like make a little bit of a difference, it's pretty awesome. Like I like the, I'd like to think we made a difference in that guy's life. Um, and a lot of that, by the way, it was our VP of technology who invested and spent time with. I spent time with him too, but not as much as our VP of tech. So while I'm sitting here like claiming some small part of his success, I should give it. Obviously the guy who created the success deserves it the most, but then his direct boss deserves more of it than even me. Um, it's really kind of a neat way to go through life. I mean, in my personal time, I coach youth hockey, um, mostly goaltenders because that's what I play. And like, it's great to spend time with kids, see them get better. It's great to spend time with adults and see them get better. The gratifying thing about turnarounds was the battlefield promotions you gave to middle managers who would have never gotten that opportunity in their life otherwise, and coaching them and watching them grow and lead. Um, like that's kind of back to like the interest and excitement in my own life, right? Like watching people grow and improve, no matter who they are, is fun for me. I really enjoy that, and if I can have a small hand in improving someone's outcomes, that's really awesome, right? Then you're kind of making a difference, like because like as I always said, the money and all that will always follow. I don't really worry as much about that. I worry more about like, am I doing something that kind of like can matter to more than just me?
You said one must keep growing on their career, uh, managing and knowing yourself. What has been this thing for you over the past year?
Yeah, well, um, I was having dinner with a guy that's equally 20 years into his career, and he was the founder of a company, built it up, and is probably going to sell it coming up. And one of the things we were talking about was the new challenges out there like AI and things like that. And you can be either excited or exhausted by those things, right? They're either opportunities or threats. And so I probably started a little bit tired, and then I because I'm used to the hype cycle of technologies. But then as time's gone on and I really read into it and got excited about it, it's like, hey, like this is an opportunity. This is a really exciting opportunity for our businesses. I'm excited to tackle it. Um, and and I guess so that's kind of part is like there's always things out there to challenge you if you view them as challenges. There's also things out there to excite you if you view them as excitement. It's kind of how you perceive the matter, right? At the end of the day, it's us who perceives the emotions or states.
The most popular tweet you did about uh, starting your own private equity firm because nobody in private equity would hire me. I lacked the PE pedigree. I wasted a few years waiting for permission to succeed. And if you are looking to start your own thing, you don't need anyone else's permission. You are good enough as is. Go do it. What's the thing today which maybe makes you feel the same way? Maybe it's going for this much larger deal or raising this extra debt to do this deal, or is there anything like this you can think of today?
I mean, it's a good question. My initial goal with Resurgent was to own four businesses. We've surpassed that, right? Um, and people was like, "Why four?" I'm like, I don't know. It just seemed like an interesting number. It's not like there was any science behind it, and so I think on our side, and I'll think about like what I love the businesses we have, but what are the types of deals I'm interested in doing? We're working on some stuff in the payments area nowadays, which is a new area to me, which is really exciting to learn about, and I didn't really know a ton about, and kind of always been a little afraid of because of PCI and all these things, and I've learned a bunch about it. And of course, once you learn, nothing's nearly as scary as you think. Um, the idea of the buy and build is pretty exciting. So I think we're working on maybe narrowing in on some theses on that, and probably in the next couple of years we'll put more energy behind that. And I think that that's also a good way, as I said, to combat the high valuations and things going on in the space in general. So it's also, strategically probably a good move for Resurgent at large. So yeah, I think those are kind of the main things.
So there is this saying, it's not like what's more important is in which boat you are, not how hard you row. So knowing this, do you ever consider, like today for portfolio companies, do you ever consider selling three in order to go absolutely all in with one specific business, one specific industry, if there is enough when it's like an extremely good wave, like a AI at this moment, for example, and in this case, you could be potentially growing through M&A and maybe this business to, I don't know, 50 million EBITDA, for example. Do you ever consider this? Because it could be a thing one day.
Yeah, I mean, I would look at it more as what's the opportunity for the business. I try not to be like, well, this business is at time sucks, so we should sell it. Again, it's back to like what's right for that business. It might be that we need more leadership in that business. It might be that we need to do something different with the business we're calling quote unquote a time suck. I don't think any of the four are a time suck. Um, so I kind of look at it more uniquely to each one. Um, I don't think I want to be the long term CEO of one business at this point in my life. So for me, that's less exciting. I think what I'd want if we went down that scenario, and it's probably an unlikely scenario for us, we would we'd want to find the right CEO to back and give that person a lot of incentive um, to be able to grow it, and maybe our job is to go out and raise capital around it to help them do add-on acquisitions or what have you, or grow however makes sense. But I would probably want to get I would think more about like, hey, this business has a great opportunity, and we got and is there somebody like, for instance, the case of Sonnen, I think there's some great opportunities ahead of it. Just saying, there will be a better CEO for Sonnen than me at some point. But I have to set the table. I have to make it a platform for them to step into that they can grow. Um, Versus when you first buy a business that has some trouble, you have to fix the trouble. And most executives don't want to fix they don't really know how. They're used to coming into a table that's set for them. So I really spend my time on trying to get the business in a position where it's growable for that person, so they don't have to do technology builds and all the stuff I'm doing. Technology builds, getting the right people in the right place, etc. All the stuff I typically do in the beginning.
I hope you've done some goal setting exercise recently because I want to ask what motivates you today and what do you want to accomplish next?
Yeah, it's a good question. I think what motivates me um, probably the most it has always been that kind of interest and excitement in my own life. We have three really interesting deals going on right now, which is actually a lot for post COVID activity. So that's really motivating me, exciting me. That hope that if you have, as you know, if you have three going on, you'd be lucky to get one over the finish line. So that's so in the short run, it's kind of like the deal guy in me, and being excited by that. I think in the long run, it's really building a track record of companies and investments that have succeeded, and having helped people grow and improved along the way. Um, I can't say it's important to be at $20 million in EBITDA portfolio or 10 or raise a fund or those things, um, because everything to me kind of blends back into what I want out of my life and what's most important to me, beyond my requirements to, make sure that the companies are doing well. Because I want to be, I want to be around for my family. I am, unless I'm at a hockey rink, I have dinner with my family pretty much every night. I'm around them quite a bit. Yes, we travel for deals and all that. But if you're taking LP money, you're going to be on the road a lot more and doing a lot more things. And everything kind of to me blends together. I don't create a line, and that I'm kind of in that phase of life where my kids are very active, and I'm a part of their life. They don't hate me yet, or or are disinterested in dad being around. So I really enjoy that. And I grew up in a time where my father traveled a lot, and he's an awesome dad. He's my best friend, but like he was around less. So my design of my life is right now is kind of to be around a little bit more. And we've built that, and that doesn't mean that I don't travel and do stuff. It just means I'm not. When I was doing turnarounds, I would leave Sunday and come home Thursday night. So I did that kind of almost consultant life. I guess it's the same as a consultant. I'm not looking to go back to that now, but it wouldn't surprise me if in a couple of years I did, or maybe like three years. So no specific goal there that I could point to and go like I've got to get uh, to this point, right? Because there's other people there's other people whose goals I have a lot of consideration for right now.
But let's say kids are older, you have the skill set, obviously you have the track record. Will you ever consider taking this LP money, building something
Probably not a
10
fund.
times larger?
Probably not a fund. That could change as Bryce and I evolve. And very important to me is to do this with Bryce. I think it's very hard to find a great partner, and I have found I've been beyond blessed to work with him. So part of it's also, hopefully, how do we evolve together? Um, we just came back from a conference where that was a constant question. You guys interested in raising a fund? And it's a tough one. I like deals doing well. I don't like the idea of having to rifle out money because I have an investment period and I got to get something done. And that just doesn't sit well with me because it's just not how I feel like one should invest. So I think that's where I have trouble with the fund models. In many ways, it's you're raising a fund and you're deploying in some macro environment. And you're kind of forced to rifle out the money because that's what you said you'd do. And look, that's what they're expecting. So it's not really necessarily a problem. Again, I don't think it adds up to my psychology of thinking about what's best for the companies, de-emphasizing finance, thinking more about operations and the entrepreneurs and what's best for the business in the context of the market it's in. That to me feels more like running a asset manager. And at least right now, that seems less appealing.
Maybe a very personal question. When did you learn this lesson, or when did you have this realization that pretty much staying with family is more important than building a huge fund? Has it always been
Yeah.
like this?
No, I think as when I was working for when I was the CTO of the bigger company, I would travel to France and when you're a CTO of a big company and you go visit the headquarters in France, they're awesome to you. They're like super kind and you get to go to the best restaurants and like they're like it's really nice. Um, but I was gone for 2 weeks and at one point that like I was hustling back to make my son's first birthday party. I got home the day before it. And it was one of those things where you're like, I didn't feel like I was necessarily making a big difference because it's a big company. It's sometimes hard to make an impact, even at the CTO level. And I'm missing these moments in my kid's life, and I think that kind of made me reflect on remembering that my dad traveled a lot, and it made me want to be home more. So yeah, maybe that was kind of the moment. It's an interesting question. I that might be the first time I've thought about that as like the lightning rod moment. Um, but when you have little kids, they hate it when you leave. Sometimes they get scared when you leave, and you don't want to. Obviously, you don't want to scare your kids, right? And if you can create success without having to do that, then that's fine. Probably better to do it that way.
Yeah, I'm just asking because thanks to Twitter, I'm having those conversations, and I'm around a lot of like hardcore finance people who wanna do and build massive companies. Many of them live in massive cities, but I'm in this small country, small market. Had my second kid and spending really a lot of time with them at home. Obviously, going to the office, but no crazy hours. So
Yeah,
that's why I'm asking from someone who's actually older than me, many years ahead of me. It's so interesting to have those conversations because eventually, of course, you make this decision based on what you want to get out of this life. But it's
right.
always interesting to hear what folks think about this.
And that's who I was in my 20s, though. I would have laughed at the Family Guy mentality I might have right now. I would have laughed at me for that. Because you're in your 20s, you're like, you want to be tough, right? You want to be hard. You want to be out there. You want to be like, you want to grind. And look, that grind has gotten me to a position that's probably allowed me to have a little bit more of a relaxing time later. So it does pay off. But like, if you don't change as a person every, 10 years, I mean, are you really growing? Are you really getting better? Or are you just kind of stagnating with the same attitude? So for me, I feel like I evolve and change quite a bit. And I find that exciting, not exhausting.
Awesome. Okay, Dan, let's wrap up with the famous five. How old are you?
45.
Favorite book?
Oh boy. I feel like, and it's sad to say, I feel like I read so little. It was a book called Illusions. I think it's by Richard Bach. Probably getting the author wrong, but that used to be my favorite, and I probably could benefit from reading it again one more time.
What car do you drive?
Tesla S.
What's the best investment advice you've ever got?
So my first boss is on the Forbes list, who's an awesome guy, and I think at the time I had like 20 or 25 grand, and I asked him what should I do with it, and he goes, and I said I don't want to lose it, and he goes, that's a killer attitude, and at that time like killer meant good. So I was like, wait, what do you mean? Because the way he said it wasn't like that was a good thing. He's like, no, if you're trying to avoid loss, because it's going to be really hard to succeed. Because there's a difference between trying to avoid loss and trying to win. And I think that may have been the basis of this kind of asymmetric model that we pursue here. And so I think that was the best investment advice I got.
As you built still a very, very large holding company doing extremely well while being a family man, I'm sure many people would like to reach out, maybe ask some follow-up questions. So where can people find you?
Yeah, Twitter's probably the easiest place. I think it's Dan_Tamkin. Um, you can also email me off the Resurgent website, dan@resurgentcp.com. Happy to talk to people. I'm less active in the Elon Twitter than I used to be. Just seems like I'm shouting into the void recently. Stopped doing the Deal Friday thing I used to do and all the other stuff. So a little quieter, but I'm sure I'll eventually I'll get back to you if you send me a note.
Okay, thanks once again for doing this. Learned a lot about the business, learned a lot about having a balance in life. So thanks a lot for doing this, Dan.
Yeah, thank you for having me. I really appreciate you spending the time.